Welcome to The Explainer. Today we're jumping into a question in economics that's, well, it's surprisingly controversial. And to get our answer, we're going to use a famous Nobel Prize-winning model as our guide.
So let's get right to it. Here's the puzzle. Can a growing population actually shrink an economy? I mean, your gut reaction is probably, no way, right? More people means more workers, and that has to mean a bigger economy. But what if that's not the whole story? The Solow growth model tells us we need to look a little deeper. Okay, so to really wrap our heads around this, we first need to break down the two big forces that are always shaping an economy. Think of them as two sides of a coin.
It's basically a constant tug-of-war. On one hand, you've got investment. This is everything we build, the tools, the machines, the factories, all the stuff that helps workers be productive. But on the other hand, you have depreciation. And that's just a fact of life, right? Things get old, they wear out, they break down. You know, there's a really great analogy for this. Think about your country's entire stock of tools and infrastructure, what economists call capital, as one big car. If you don't keep investing in it, doing the oil changes, replacing the tires, it's just going to run down. And the less you can use it, the less you can produce.
All right, so that seems straightforward enough. Investment builds things up, depreciation wears them down. Easy. But here's where it gets really interesting. This is the twist. What happens when you throw a growing population into that mix?
Well, this brings us to a really powerful idea called capital dilution. And it's a super important concept. See, more people doesn't necessarily break the machines faster, but it means you have to share them. The existing tools get spread thinner. So if you used to have one tractor for 10 farmers, well, now you might have that same tractor for 20 farmers. Each person gets less. And this is the core insight from the Solow model, the big takeaway. It says that population growth acts just like depreciation. It's this other force that's constantly wearing down the amount of capital each worker has to use.
So think about it. Now your investment dollars are fighting a war on two fronts. You're not just trying to replace the machines that are breaking down. You also have to find a way to equip all these new workers who are entering the workforce every year. It makes it so much harder to just tread water, let alone actually get ahead.
So what's the upshot of all this? Well, this whole line of thinking leads to a pretty stark prediction, a prediction we can actually test by looking at the real world.
And the prediction is this: all other things being equal, countries with higher population growth are going to end up with less capital for each worker, and that means they'll have lower incomes in the long run. It's a really powerful statement.
You can literally follow the chain reaction. High population growth leads to less capital per worker. That in turn makes each worker less productive. And what happens when people are less productive? They earn less, lower income per person. It's a domino effect.
Okay, but that's the model. That's the theory. Does it actually hold up when we look at the real world? Let's take a look at the data.
And wow, when you put the numbers on a chart, the pattern is pretty hard to ignore. You've got countries with high population growth like Pakistan and Egypt, and they tend to have lower income levels. And then you look at the other side of the coin, countries with low population growth like Germany and Denmark, and they tend to have much higher incomes. It's a really strong correlation.
Now, if you want a real-world experiment, look no further than China. They were facing this exact problem of capital dilution from rapid population growth. Their solution? The one-child policy, which drastically slowed things down. And what happened? Just like the model would predict, their economic growth absolutely exploded as investment per worker shot through the roof. But, and this is a big but, it created a brand new problem down the road, a rapidly aging population with its own set of economic headaches.
So this all leads to a really important question, right? If high population growth is a drag on the economy, does that mean the ideal situation is zero growth? Or even a shrinking population?
Well, the answer is a definite no. It turns out you can have too much of a good thing, and you can also have too little. Too much growth, and you get that capital dilution we've been talking about. But too little, or even negative growth, that leads to a whole different set of nightmares. An aging workforce, pension crises, economic stagnation. I mean, that's the kind of challenge that places like Japan and even Germany are wrestling with right now.
So it seems like there's a kind of Goldilocks zone, a sweet spot. The data suggests that a modest growth rate, something around 1.5%, might be just right. It's enough to keep the economy dynamic without completely overwhelming its ability to invest and equip its workers.
And that really leaves us with the final big picture takeaway.
The Solow model shows us that economic prosperity is so much more than just money and machines. It's this incredibly delicate dance between demographics and development. And it leaves us with this massive, ongoing question. How do you balance the needs of today with the people of tomorrow? It's a puzzle every nation on Earth is trying to figure out.